Hello everyone and welcome to today's webinar. My name is Jacques now and I'm broadcasting today here from South Africa. I'm the Forex educator here in South Africa. So for today we are going to discuss the Bollinger Bands strategy. But ladies and gentlemen, if you can please, before we start, just let me know if you can hear and see me. That would be excellent. If we can do a quick sound check and if you can see my screen, that would be lovely. Excellent. Alejandro, Gerard, thank you for that, guys. Okay, it seems like the sound and the visual is excellent. Thank you for that, guys. Richard. Okay, seems like everything is working fine, guys. Let us continue with today's presentation. Okay, so I'm going to start by giving you the contents for our discussion today. Like I said, we're discussing the Bollinger Bands strategy. So I'll have a quick introduction and I'll discuss a little bit about the pitfalls and the potholes we as new traders like to step in. Then I'm going to give you two rules. So ladies and gentlemen, this rules is not only specific to my strategy, but I believe this is something if you apply it to any trading strategy, it will greatly help you in reaching consistency. Okay. Then we're going to discuss a little bit about indicators. What indicators we're going to use. Obviously, Bollinger Bands is at the heart of it all, but it is not the main indicator, and we'll get to that a little bit later. Then we're going to talk about the entries, take profit, and stop loss. Okay, so guys, I really want you to be very sure and confident about exactly where do you enter. There must be no doubt as to where you enter, where you put your stop loss, and where you put your take profit. Okay. Then we're going to discuss exits. And yes, there is a difference between a take profit, a stop loss, and the exit. Okay. So the exits we are going to discuss is dynamic. That means it adapts and changes with the market. Okay. So it's not a fixed level or a fixed number of pips like a take profit and a stop loss. It's dynamic and it basically adapts with the market. Okay. Then we're going to talk about filters. So how do we filter out the better trades from the not so good trades? Okay, so that's always an important part of a strategy, is to filter out the better trades, because guys, we only want the high probability trades. Am I right? That is what we aim for, is the high probability trades. Okay, then we're quickly going to discuss, depending on time, what type of trader you are and why a lot of people struggle with trading. Okay, it's a very psychological game, this one. And then we're going to talk about the trading plan. How that's just a bonus that I'm throwing in. That is how you can help yourself with the psychology of trading. Excellent. Let's continue. Okay, so when we start out with trading, we've got our trading charts. Our price charts. This is Great British Pound, US dollar on a daily time frame. And now we want to start trading. Okay, so what do we do as beginners? We say, okay, let's try Bollinger Bands. And let's put another set of Bollinger Bands. And let's add a 50 period moving average. And what about 100 period as well? I heard my friend says that 100 period simple moving average is the key to success. Then another friend told me, no, but RSI is a very popular indicator. You must use that in your trading. So what do? We add that to our trading as well. Then there's another friend that say, no. I'm using ATR, the average true range. And for me, that is the key to success. So what do? We also throw that in the mixture. Okay. After that, we heard about the alligator strategy. Okay. We saw it on the Forex Time website and we said, okay, no, I also want to incorporate that with my own trading. So what do? We add the alligator indicator. Then another friend of mine said he's using MACD, moving average, convergence, divergence. And I add that as well. And zigzag. I saw that indicator in the MetaTrader 4 platform. And with that, parabolic stop and reverse. Someone told me that that's also working excellently. Okay, and we add the Ikumuku indicator as well. And don't forget about the stochastic. So, ladies and gentlemen, does this look like something that you can trade from? Does this look easy to follow? Does this look like something that can make you money or can be simple to follow? Absolutely not. Okay. So one of my first rules, ladies and gentlemen, is keep it simple. Leonardo da Vinci said simplicity is the ultimate sophistication. And that is also today what I'm going to try to do, is to present to you a strategy that is simple to follow. Why is that? Why is that so important? If your strategy is simple, okay, it will be easy for you to know when to enter the market, when to exit, and you will not have any doubt as to your position size, your exits. All those things will be simple, okay? So it will be easy to follow because there's not 1,000 rules that you must follow just to enter the market, and another 500 rules you must follow to know exactly where to exit the market. And then doubt starts creeping in because you don't know, is this a valid entry or not? So the first thing, guys, ladies and gentlemen, let us keep trading as simple as possible. Okay. Now, the next thing, we've got a price chart here in the background, and we've got two indicators, the stochastic and the RSI. And for those of you who know, this is oscillators, the stochastic and the RSI. It's got an overbought and oversold regions right over there. Okay. So what does it usually tell us? Okay. There's a popular strategy or approach to the markets that says that if our oscillators, whether it's RSI or stochastic, a lot of people use it in conjunction with each other. If our indicators is overbought, which is meaning they are in the top area over here and above our oversold line over there, if they are overbought, then probably price will go down. And if they are oversold, as the case here and there, then probably price will go up. So what do? We rely on the indicators. We say, okay, over here I see it's oversold, my stochastic, and my RSI is oversold. As well as this is a range on top here. So according to popular belief, stochastic is telling me price will go up, and the RSI is telling me price will go up. So what do? We buy. And what happens next? Oh, price went down. But this time, look how much time it spent in the oversold region. So stochastic says price must go up, and RSI says price must go up. So what do? We buy again. Okay, we add to our losing position. And what happens next? Price went down even further. Now we said, okay. But it is very rare for RSI to be in the oversold region this long. Look how many bars RSI have been in the oversold region. So definitely, according to RSI, price must go up. So what do? We buy again. And price still continued to go down. Okay. So this is also one of the pitfalls we like to step in. Okay. We've all been there. You know, guys know what I'm talking about. So what is my second rule? My second rule, I'd like to demonstrate it to you with a story of a king. So this king had a couple of servants. Okay. So the first servant's name was MACD. That's moving average, convergence, divergence. His second servant was the RSI, relative strength indicator. Then he had another servant called Bollinger Bands, and yet another one called the simple moving average. Now, guys, if you can please type in the answer, guess the name of the king. If this is all the servants, who can tell me the name of the king? Any idea, guys? Any idea who the king is? Okay. Alejandro, no, it's not you. It's not you, Alejandro. The king is price. Okay, price is the king, guys. Why do I say that? Why do I say that? Okay, all of these indicators are derived from price. Okay, not vice versa. Constantina, excellent. Price is the king. You are correct. Okay, so price is the king. Let's go back a slide. If we go to this slide, all of these indicators are derived from price, not price derived from our indicators. Okay, and again, when we trade, we are going to make or lose money based on price movement, not on indicator movement. This indicator can tell you buy, but if price is going down, you are going to lose money. Okay, so price is the king. All of these indicators is derived from price, and we are trading in the most fundamental part of trading. We are trading price action. We are trading whatever price is doing. Okay, so no matter what the indicator says, all right, we are going to make or lose money based on price movement. Okay, now I'm not saying we are not going to use indicators, and I'm not saying there's no place for indicators. Okay, but we are going to base, the second rule is we are going to base our reason for entering a trade on price. We might ask the indicators, did price move enough in this direction, or is the move strong enough? We might consult our indicators, but we are not going to base our entry on the indicators alone. It's always going to be based on price. Okay, so that's the second rule. And ladies and gentlemen, like I said, no matter the trading strategy you follow, whether you follow the Bollinger Bands strategy, or you follow failure swings, or you follow whatever strategy is, or the alligator, name the strategy, but these two principles, to keep it simple and to always follow price, you cannot go wrong. Okay, you cannot go wrong with those two rules. That will greatly help you in your trading. Okay, now let's quickly talk about the indicators that we are going to use. Okay, so in the heart of it all, you guessed it, guys, the Bollinger Bands. All right, so this is basically how the Bollinger Bands look on a price chart. So what do we have? If you insert the Bollinger Bands, okay, in the center, we're going to call this the Bollinger Middle Band. That is going to be a 20-period simple moving average. Okay, then how do we get the top and the bottom line? We simply add one standard deviation. That's a calculation you make. One standard deviation to the simple moving average, and that will give us a top band, and we subtract one standard deviation from the simple moving average to give us the bottom Bollinger Band. Okay, so we've got the Bollinger Middle Band, and then we've got the two one standard deviation bands. So I'm quickly going to show you guys in MetaTrader 4 how do you insert that. Okay, let me delete them first here. Okay, so this is MetaTrader 4. Most of you should be aware how the platform works. There's great resources online if you are still not familiar and confident in MetaTrader 4. So I'm just quickly going to run over it. We go to Insert, Indicators, Bollinger Bands. So the first one we insert is a 20-period, one standard deviation, Bollinger Band, and I'm going to make it blue for the sake of this presentation. Okay. Then we're also going to insert indicators, Bollinger Bands again. This time again 20 periods, but this time the two standard deviations, and I'm going to make it red. So here we've got two sets of Bollinger Bands on top of our price chart. Okay. Right. Now, how do we calculate? So, okay, so ladies and gentlemen, this is just a bonus. You do not have to know this. MetaTrader 4 is going to do all these calculations for you. But I'm quickly going to run over how do we get the Bollinger Middle Band? That is this 20-period simple moving average. It's very, very simple, guys. To calculate that, we take all the closing prices starting 20 periods back and we add them together. up until the last candle. So starting the 20th candle back, we start adding the close prices all the way up until the last candle. Then we are going to get a total, which is this number over here. Now, how do we get the mean or the average? Because it's a moving average. We're simply going to take this total over here, divided by 20, because we counted 20 candles, and this will be the price where the most recent plot will be for the Bollinger Middle Band or the 20-period simple moving average. Excellent. Like I say, guys, and this is not necessary for you to know. MetaTrader 4 does all the calculations for us in a matter of split seconds. Okay. Now, how do we calculate the standard deviation? So we said to get the upper and the lower band, we simply take the Bollinger Middle Band, which is this line over here, and we add 1 standard deviation there, or subtract 1 standard deviation here. So how do we get that? The first thing we need, okay, is the mean. So we already calculated the mean in the previous slide, okay? Then from there, we're going to take the distance between the mean and the closing price, and we're going to square it. So we add all these numbers up until the last candle, okay? And then we're going to get a total again. From there, we are going to divide this number by 20. And because we squared everything, now we want the square root again of that. So the value here is 0.17046, okay? So what we're going to do now, or what MetaTrader does for us automatically, it takes this value, that is a 1 standard deviation, and it adds it to our mean over here, and this is how we get the blue line over there. And when we subtract it, this is how we get the bottom one over here. Simple. This is just for information's sake. You do not need to know this to work with the strategy. All right. So now we added the 20-period 2 standard deviations bands as well. So ladies and gentlemen, this is the setup that we are going to use for our Bollinger Band strategy. I'm quickly going to recap. Over here, we've got the 20-period simple moving average, or the Bollinger Middle Band. It's one and the same thing. Bollinger Middle Band or 20-period simple moving average in this case, because it's a 20-period Bollinger Band. So that is our first line. Then we've got the 2 blue lines, okay, which is the 1 standard deviation lines over here. And we've got the red lines, the 2 standard deviation lines over there. Okay, is that clear for everyone? Everyone still with us? Excellent. Okay. Olumide, what does the period mean? Okay, the period is basically just how many candles you use to calculate a specific indicator. So in our case, we said it's a Bollinger Band 20 period, meaning it takes the last 20 candles to calculate these lines that we are using. Okay, so if we use the Bollinger Bands 10 period, 2 standard deviations, it will only use the last 10 candles, okay, to calculate these lines for us. Does that make sense, Olumide? Excellent. Okay. I hope that answered you. Now, let's get to the juicy part. How do we enter and exit our trades? Okay. So once again, ladies and gentlemen, I'm going to take you to MetaTrader 4. This is our setup. Okay. 4 lines. The Bollinger Middle Band over here, the 1 standard deviation lines, which is the blue ones, and the red standard deviation, 2 standard deviation lines, which is these ones over here. Okay, that is our setup. Very simple. Okay, now how do we enter the market? Our first condition, we are looking for 2 candles that must close in between the 2 blue lines, meaning the upper and the lower 1 standard deviation line. That is our first condition. Our second condition, okay, bear with me, all of this will make sense now. Okay, our second condition, the next candle must close outside the upper or lower 1 standard deviation bands, above for a buy, below for a sell. So how does this look? First condition, two candle closes in between the two blue lines, the 1 standard deviation lines. So there's the close price and the close price. It doesn't matter the opening price and it doesn't matter the color of the candles, as long as both of them close in between the 1 standard deviation lines. That is our first condition. It is met. Now, our second condition says the next candle must close outside the 1 standard deviation bands. So you can see this candle over here closed outside the 1 standard deviation bands. So it closed above it. That means it's going to be a buy. As simple as that. Now, let's look at where do we put our stop loss and take profit. So we enter at the close of this candle because the previous two, you'll just remember the words inside, inside, out. As long as you remember that, you've got the strategy. So it's a close inside, a close inside, and a close outside. So once it closed outside, we buy. Because it closed above, we buy here. Our stop loss is the low of this candle. And then our first take profit is at a 1-to-1 risk reward, meaning whatever the distance is over here, from your entry to your stop loss, you're going to take the same distance to your take profit number 1. Okay, does that make sense, everyone? Excellent. Okay, now let's look at the example. Okay, so we have an inside, inside, outside. Okay, inside the blue lines, outside the blue lines. So it's above it. So we buy here. Our stop loss is at the low of this candle, and we've got a 1-to-1 risk reward ratio right over there. And what happened a few bars later? A few candles later, price went up and we reached our 1-to-1 profit target. Excellent. Now, I've got some few questions here. Wayne Overston is asking, is it a 1 hour time frame only? No. Wayne, you can use this strategy on any time frame. But like with the example with the king, remember, the bigger the time frame, the bigger the territory of that king, the more powerful that king price, okay, the more powerful he is. So with the lower time frames, obviously there's a lot more noise and you can get stopped out more often. But I would suggest the higher time frames, 1 hour, 4 hour, daily. That would be my suggestion. Okay. Right. I hope that is clear to everyone. We're going to look at a few more examples. So all of this will be practically as we go on. Okay. But for now, let us just cover the theory quickly. Okay. So that was how we reach our 1-to-1 take profit. Now, we are also going to enter a second position. Okay. So when we enter, we can enter 2 or 3 positions. Okay. And I'm going to discuss the second and the third position with you now. So our second exit, and this is a dynamic exit, guys. This exit adapts to the market. The 1-to-1 risk reward ratio, you already said that before you enter when you enter your trade. You already know once price reach this area here, 1-to-1, I'm taking my profits off the table. Okay. But then because you enter 2 positions here, you still have 1 position open. Okay. And no, you're not going to bring it to break even or anything. The stop loss stays exactly where it was initially placed. Okay. Now, for our second exit, we want 2 closes. Okay. 2 closes on the opposite side of the Bollinger middle band or the SMA 20. Okay. So meaning we entered a buy trade here, meaning we entered above the Bollinger middle band. So now to exit our second position, we are going to wait for 2 candles to close below the Bollinger middle band. So how does this look practically? Let's look at our setup. Okay. Remember, inside, inside, out. Now we enter at the close of this bar. We enter with 2 positions. Okay. Our first position, we put the stop loss over here and the take profit over there. Our second position, we put always a stop loss, but no take profit. The take profit or the exit is going to be dynamic. So this candle gave us a 1-to-1 risk reward. So our first position is off the table now. Now we are only left with one more position. Okay. Now, how do we know when to exit that position? We are looking for the second close on the opposite side of the Bollinger middle band, meaning below it. So let's have a look at this. Here's our first close. So we ride this trend all the way. We're not exiting yet. Even here, when it comes back into the bands, we're still in the position, Here is our first close on the opposite side, meaning below, because it's a buy. And there is our second close. So we are only going to close this position right over there. Okay. And if you calculate it, that is a risk reward of 1 to 14. Okay. That's an enormous risk reward. All right. So we're going to look at a few examples as well. Let's quickly cover the sell side. Okay. So remember what we said. Our first condition, inside. Our second condition, outside. So here we've got inside the blue bands, inside the blue bands, or the one standard deviation bands, and our second condition, outside. So we've got inside, outside. It broke to the downside, meaning it's a sell. So we sell at the close of this candle. Our stop loss is at the high of this candle. And then we have a risk reward of 1:1. And let's see how that worked out for us. So let's check it again. Inside, outside. We sell at the close of this candle. Our stop loss is at the high of this candle. And our take profit is at a 1-to-1 risk reward. And price went against us a little bit, didn't take us out at the stop. And it started going in our favor. And right over here, we've got a 1-to-1 risk reward. Okay, so we've ended with two positions. Our first position is off the table with a profit in our pocket in this example. Now we are still left with one more position. Okay, now this position, okay, let's see where do we exit with that position. We said the second close on the opposite side of the Bollinger middle band. So inside, out, we sold there, stop loss there, take profit there. Two positions. Our first position hit our profit target right over here, and the second position is still running in favor, still running. Okay, right now here's the first close on the opposite side above. Now there's the second close on the opposite side, so we closed out that position with a risk reward of 1 to 3. Okay, meaning we gained 3 times what we risked on the specific trade. Okay, is that clear to everyone, guys? Excellent. Now, I explained to you that you can have 2, and if you want, a third position as well. Okay, so the third one will be a very small position size. And why is that? That's also for the psychology. Okay, because as traders, there's that thing that we always want to be in the markets. Okay, and if you are struggling with that, I would suggest put in a third position with a very, very small lot size, and you can use that for bigger profits. Okay, pips wise. Okay, so how does it work? We've got our inside, out. Now we can enter if you want with 3 positions instead of 2. So our first position will be taken out with a profit over there, 1-to-1. Our second position will be taken out there, the second close on the opposite side. And your third position, you can either close it on discretion because it's a very small position size compared to the rest of your trades. Okay, or you can say I'll close it when there's a new buy setup. It's up to you. Okay, so that is basically a buy and a sell example. Let's quickly look at a losing example. Okay, because we like, as traders, we like to ask ourselves, how much money can we make? But seldomly we ask ourselves, how much money can we lose? Okay, so let's look at an example of a loss. Our first condition, we said, is inside, out, inside the blue bands, outside. It went above, so it's going to be a buy. We buy at the close of that candle right over there. Our stop loss is at the low of the candle, and our take profit is supposed to be 1-to-1, which will be somewhere over here. But to illustrate a loss, immediately after we enter the buy trade over here, the market just reversed and it hit our stop loss right over there. Okay, so that is good because it is a pre-calculated loss. Okay, we told ourselves before we entered the trade, I'm willing to lose 0.5% or 1% of my account, or I'm willing to lose $5 or $10, whatever it is that your risk appetite is. Okay, so always, guys, always use a stop loss. Okay, in the specific strategy. Right, now let's quickly talk about filters. Okay, let me just see, we've got another question here. Okay, Osezua, I hope I'm pronouncing it correctly. Let me see, you missed how to put the indicator. Okay, let me quickly refresh you on the indicator. That is a very quick process. We're going to go to MetaTrader 4. Okay, so what you do if you want to insert the indicator, I'm going to delete this one over here. Okay, so we already have the one standard deviation Bollinger Bands inside. You go insert, indicators, Bollinger Bands. Okay, then you're going to say the period is 20, the deviation is 2, and you say okay. Can you see there we've got our second set of Bollinger Bands. Okay, it's a very simple process. If you're still a little bit unclear, you are welcome to go and check on our Forex Time website. There's a lot of great resources, okay, specifically on MetaTrader 4 as well. So guys, if you are not yet comfortable with MetaTrader 4, I would strongly advise you go and have a look at those videos. Okay, let's quickly discuss the filters. So why do we have filters? Okay, so filters just helps us to filter out the better trades from the not so good trades. Okay, not necessarily bad trades, but they are not that good. The probability is not that high for reaching our profit targets. Okay, so as traders, we will tend to take the higher probability trades. Okay, there's a saying I like, sometimes less is more. Sometimes not being in the market, guys, is also a position. Not entering in trade is also a position. It means that if you are not certain, if you're not comfortable with the trade, okay, rather don't enter than entering and losing money. Okay, so let's quickly talk about filters. The first one I would like us to talk about is the simple moving average 200. Okay, so I'm going to go to MetaTrader 4 again, and what I'm going to do on this chart of mine, I'm going to add a simple moving average 200 period. So I'm going to say insert indicators, go to moving average. The period is 200. The method is simple, not exponential or linear weighted or anything else. And we apply it to the close price. And I'm going to make it yellow for this example. So here we've got a yellow line, which symbolizes the simple moving average of 200 periods. Okay. Now, how do we use this? How do we use that moving average? So what we do, is very simple. If price is below the yellow line, we only look to sell or short the market. If price is above the yellow line, we only buy or go long. Okay, so let's look at this. Here we've got a buy setup. Okay, and as you can see, probably we would have been stopped out for a loss, but because we used this filter to stay on the same side as the longer term trend, we did not enter this trade, or we only entered it with a smaller position size. Okay, because we are below the moving average 200 period, so we only go short, or we go long with very small position sizes. Okay, let's look at another example. Over here, you can see as well, there's a buy setup, but we don't go long because we are under the 200 period moving average. And over here, you can see as well, we've got our inside out, and we don't go long. As you can see, we would probably also have been stopped out here for a loss, but we never entered the trade because we are below the moving average and we only look for short trades. Okay, now let's look at another filter. What is the size of the candle, the signal candle? Let's have a look. Can you see here, we've got a nice sell setup as well. Inside, out. Do you guys agree with me? This is a sell signal. Excellent. Now, we sell at the close of this candle. Our stop loss is at the high of the candle. Now, how far must the market travel before we reach 1-to-1 risk reward? Can you see it's such a small distance because the candle itself over here is small. Now, let's look at another example. Can you see this candle is much bigger? And look how far the market must travel before we reach a 1-to-1 risk reward. And look at this candle. It's also a sell signal, inside, out. But look how far the market must travel, even though, yes, we hit our 1-to-1 risk reward, but it took the market a long time. And I almost want to say it's a lot of effort for the market to reach this level because it is quite far away. Okay, so that is something to take in consideration as well. Okay, we don't want the candle to be too big. And if you look at this as well, even though this is not a valid buy setup, but usually after a very big candle, the market retraces. Okay, that's also sometimes what happens. Okay, so we don't want to enter if the candle is too big. Okay, and that is why we've got the red bands as well, the 2 standard deviation bands. If the candle closed way outside of the 2 standard deviation bands, the red ones, that is also an indication that probably the market already moved too far and that maybe it will not be a good idea to enter now. Okay, let's continue. Now, ladies and gentlemen, I would say this is one of the most important filters that we are going to discuss now. Okay. Okay, let me just see. There's a few questions here. Let me try to answer them quickly. Okay, Ernest Pule. Hi, Ernest. Can you explain how to set a trailing stop loss? And is it wise to apply it? Ernest, thank you for your question. Yes, I would say it is wise to apply it, but not with a strategy. Okay, you do not put a trailing stop loss or move it to break even. Okay, why do we use trailing stop losses? Trailing stop losses is we want to lock in as much profit as possible. Okay, but what usually happens is you will trail your stop and the market will turn around, hit that stop loss, and then continue in your favor. Let's say you put a trailing stop loss from here. There's a valid sell setup there. So you would go down. Once the market is here, probably your stop loss will be somewhere there. The market will take you out there and look how much the market still moved in your favor, but you are not in the market anymore because you had a trailing stop loss. Okay, so there is some strategies that does quite well with trailing stop losses, but this is not one of them. So I would not advise you guys to do the move to break even or trailing stop losses. That would not be my advice. Obviously, you can experiment if you want, Ernest. There's no problem with that, but that would not be my advice for the specific strategy. Okay, Cynthia. Okay, Cynthia, I think. Okay, Cynthia's asking, why are we using the second standard deviation bands? Okay, that's an excellent question, Cynthia. I'm just going to go back to this slide over here. I think probably you asked the question before I covered this. The second standard deviation band is to judge if the candle is too big or not. So if you look at this candle, it closed way outside of the 2 standard deviation bands. So I would say physically this candle is too big, and if I look, this is now where I consult my indicator. I can see that price went up a lot. Now I'm asking the 2 standard deviation bands. 2 standard deviation bands, did price go up with too much? And then the indicator will tell me, yes, that candle closed way outside the 2 standard deviation bands, okay? Even though this candle, let's look at this one, even though this candle is quite big, but look, it didn't really close far outside of the 2 standard deviation bands. So I would say, yes, this is maybe even a better candle, okay? Even this one, yes, this candle is a little bit bigger than the rest, but it did not even close outside the 2 standard deviation bands. So the 2 standard deviation bands, Cynthia, to answer your question, is also there to help you judge if a candle is too big, okay? Because too big is quite relative. So I added that indicator, that line, for you to judge whether the candle is too big or not. Okay, then Abdul, same questions, the 2 standard deviation bands. Yes, we use it, like I said, to judge if a candle closed too far outside the bands already, if the candle is too big or not. Okay. Then Kumu Morupule, can the 50 period simple moving average be used as a filter as well? Kumu, yes, you can use the 50 period. It's not a problem. But I have done a lot of tests with the strategy, and I find that the 200 period simple moving average works quite well. But like I said, you are more than welcome to experiment, and sometimes I would even encourage that, to make the strategy your own as well. Find something that works for you, but this is something that I find works the best. Okay. Okay, ladies and gentlemen, what I'm going to discuss with you now, I believe, is one of the most crucial filters for the strategy. If you can master this part here, I think that would be very, very advantageous for you. Okay, so there's a phenomenon in Bollinger Bands that occurs in Bollinger Bands that's called the Bollinger Band squeeze. Okay, so what is that? That means that the 2 bands gets very close to each other. This is a typical example over there. If you look at the Bollinger Bands over here, you can see they're quite far apart, but here they are very close to each other. Now, what I found as well with the back tests is that if this entry occurs close after a Bollinger Band squeeze, then there's usually a very strong price move. Let me illustrate. Okay, so look over here. That's definitely a Bollinger Band squeeze. Look at that beautiful, strong down move directly after the Bollinger Band squeeze. Okay, and look over there. Can you see the bands are quite close to each other compared to this area here? They are far apart and far apart, but right over here they are very close to each other. Look again, that nice strong down move immediately after the Bollinger Band squeeze. Okay, and let's look at another example. Can you see over here as well? Bands came close to each other, and immediately after that, a very strong move to the downside. Now, for those of you who've been trading a while, you'll tell me about the fake breakout to the top over there. We've got a fake break to the top over there. So the market just went up, and immediately after that went down. We had the Bollinger Band or the Bollinger squeeze, the market went up, and immediately after that went down. Same here, Bollinger Band squeeze, break to the upside, and immediately after that we go down. But luckily to our filters, you are not going to enter a long position here. Okay, so the filters will a lot of the times, okay, would have saved you. Even here it would have saved you. All right, you were probably only going to enter the market either here. Where's another sell? There's another sell. There's another sell signal. You see, there was 3 opportunities for you to enter with a sell signal over there. Let's see over here. There's a sell signal. There's a sell signal. And no, there's another sell signal. Let's see over here. You are not going to go long because you are below the moving average. Okay, this candle is also very big. This candle is also very big. So probably you were going to sell there. Okay. Yo, this trend is very strong. Okay, maybe we're going to sell there as well. Okay, so you guys got it. The Bollinger Band squeeze, in my opinion, is one of the strongest filters, okay, for this strategy. Okay, now, what type of trader are you? Okay, and I think a lot of you will be able to relate with me, but usually when you start out your trading journey, you will change between strategies so often. Okay, so you will not be disciplined, you will not be focused, and I found in my personal journey that that is something that's quite detrimental for me. Okay, why do I say that? Let's look at a practical example. Okay, okay, Jose Jardim is asking how accurate is this indicator for the strategy. Okay, Jose, this indicator is it's a trend following strategy. Okay, so what does that mean? That means that usually, okay, we will risk a small amount of pips wise, in order to gain a lot of pips, because we want to stay in the trade as long as possible. If we are wrong, we get out soon, get out fast. But if we are right, we want to ride that trend as long as possible. Okay, so like I showed you earlier, there's times where you get 1 to 15, 1 to 20, 1 to 25. I had trades where I've got 1 to 56 risk reward ratios. Okay, but the downside is you'll be wrong a lot of the times. Okay, but that is fine, because even though you might be wrong a lot of the times you are right, and I'm going to demonstrate that now as well. The times that you are right, okay, you are going to make up for a lot of losing trades. Okay, do you account, Kabelu, do you account for the spread on your risk reward 1-to-1? Yes, basically, Kabelu, you just enter. I'm going to show you. Let me show you practically how you do it in MetaTrader 4. Let's look at a nice example. Let's zoom in a little bit. Let's look at an example. Okay, we've got inside, outside. So where will we enter? Okay, we'll enter right at the close of this candle here, because we've got inside, outside. Then where's our stop loss going to be? Okay, it's at the low of this candle over there. So our risk reward, you take this to the crosshair over here, and then you measure from there to there how many pips. So you can see that's 200, so that's 20 pips, 200 points, so it's 20 pips. Okay, then you're going to put, then you can calculate it. You just take this price over here, your entry price, and you add that amount to it. It will give you exact price. Okay, or you can just measure it from here, right over there, a little bit higher. There is 20 pips. Okay, okay, so that's more or less a 1-to-1 risk reward. Okay, but you can obviously calculate it now by subtracting the close and the low price and adding it to your entry price. Okay, excellent. Okay, Olumide, do we see the squeeze before the price action, and how do we know it's long or short? Okay, so Olumide, Olumide. Okay, so the squeeze, definitely you can see it before the price action happens. Okay, and to know whether it's long or short, you look for inside, out, and when it breaks outside of the blue lines to the top, it's a buy. Let's take an example. Let me try to find an example for you. Okay, so here you can see there's a squeeze. Okay, guys will agree it's quite a long squeeze. Okay, so we've got inside, it closed inside, outside the blue lines, and it broke to the top side of the blue lines, meaning we are going to buy. Okay, so we were going to buy there, stop loss over there, and we were going to exit first candle, no, second, first, second, we were going to exit the trade right over there. Okay, that's a very, very nice piece of profit. All right. Okay, let me see any other questions. Okay, Jose, I think I answered you. Olumide. answered you. Okay, let's go back this side. Okay, so guys, I would like to give you an illustration, like I said, of jumping between strategies. Okay, so with trading, if you are disciplined and persistent, your chances of success just becomes much higher. So let's look at a practical example. We've got two traders, okay, John and Alex. John is a disciplined trader. John is focused. He sticks to a strategy because he backtested it for himself. He practiced it on a demo account. He knows for him, this is a strategy that he's trusting. Okay, that's John. Alex, however, he's not very disciplined. So both of them, they use this strategy. Okay, so they enter a trade. Okay, they win the 1-to-1 risk reward, but they lose the other one, the second position. Same this side. Another loser, another loser, another loser. Now we've got 4 losers in a row. Now Alex is starting to say, no, this strategy doesn't work. I don't like this strategy. Okay. John says, I've backtested it. I know it works. I've got trust in my system. I've got discipline to stick with my strategy through the good and the bad times. Okay. What happens now? There's still another 1, 2, 3 losing trades. Now Alex says, no, I cannot take this anymore. This is not for me. This strategy doesn't work. So Alex goes out. He stops trading this strategy and he looks for another strategy. Okay. John says, I've tested the system. I know it works. Even though there's some drawdown periods and some losing trades, I know the system works. Okay. Now, John's got 1 more loser and another loser, and he still stays in the strategy. What happens next? Okay. Look at this, guys. There's a nice buy entry. We're still in the trade. Even here, we're still in the trade, still in the trade, still in the trade. First candle closed below, second one above, so we don't exit there. Right. Below, and another one, second one. So John exited this trade with a 1-to-24 risk reward. So John just basically paid for 24 losing trades. Okay. And he had 1, 2, 3, 4, 5, 6, 7 losing trades, but he paid now for 24. And let's see what happens even a while later, because John also opened the third position that I spoke about earlier. Okay, the discretional position, and he just let it run. He believed the long-term trend will still go up. So let's see what happened there. That is 1-to-56 risk reward. Okay, can you see, guys, this is trend following. Okay, I think Jose, you also asked earlier the accuracy. There was a couple of losing trades in a row, couple of them. Okay, but look, after a while, this enormous move that you were able to catch. All right, and this is part of trend trading. Now, what is there that we can do to help us? Okay, to help us stay disciplined and focused. All right, what is there that we can do? Now, a trading plan is something I would very, very strongly advise. So what is a trading plan? A trading plan is a document you set up. You can laminate it and put it next to your computer. You can put it on your door where you're trading from. You can memorize it, but I would suggest having a trading plan. So this is the trading plan that I'm using. Okay. The first thing I ask myself, is there a close of a candle outside the 1 standard deviation Bollinger Band? Secondly, is the previous 2 candle closes inside the Bollinger Band? So in essence, what am I saying? Inside, inside, out. So I'm asking myself. Let's zoom in a little bit. Let's look at an example. Okay. Okay. So here we've got a inside, inside, out. Okay. We've got inside, inside, out. So this will be a valid buy trade. Okay. Okay. Kunle Daniel is asking, why do you pick trades at the 20 simple moving average? Okay. Kunle, you only close the trades using the 20 period simple moving average. Okay. We'll get to that now in a second. Again, I'll just do a review for you guys. Okay, let me actually take a trade a little bit further back, so we can go through the closing as well. Okay, let's look at this example. Okay, so we've got inside, inside, out. All right, so we're going to sell over here, our stop loss over there, and that is our first two conditions. So let's go back to the trading plan. So the first thing we said is there a close of the candle outside? Yes. Does the previous two candles close inside? Yes. Now, what does the 200 period simple moving average tell me? That is a very important question. Fourthly, what does the size of the candle tell me? And this is also where we use now the 2 standard deviation bands. Number 5, is there a recent Bollinger Band squeeze? Okay, how much will I risk on this trade? And then I place my stop loss at the low or the high of the candle. I place my 1-to-1 risk reward, and from there I monitor my trade and exit at the 20 period simple moving average. Okay, so let's go back to our example. So we've got inside, inside, out. So we enter the trade over here. Our stop loss, let me just make this line straight. Right. Our stop loss is at the high of that candle. Okay. Then we've got a 1-to-1 risk reward, which will be more or less more or less over there. Okay, so inside, inside, outside, we sell over here, stop loss over there. Then over here we hit our 1-to-1 risk reward. Now we are looking for the second close on the opposite side of the Bollinger middle band. So here's our first close, but then our second close is not on the opposite side. Okay, not on the opposite side, so we're still in the trade over there. That is our second close. All right, so that is how we do it. Now, what does the 200 period simple moving average tell us? Does it say we can sell? It doesn't suggest a sell trade. It only suggests a buy trade, okay? Because price is above the simple moving average. So does that mean we're not entering at all? Not necessarily. Our first condition was met. Inside, inside, outside. Then the 200 period simple moving average did not suggest or did not agree with the setup. But that does not necessarily mean we are not going to enter. That is a personal choice. Okay. What does the size of the candle tell me? Is it too big? Is it too small? Okay. Was there a recent Bollinger Band squeeze? Yes or no? Now, based on all of this previous 3 filters that we are using, that is how we will determine, okay, whether we will enter or not. Or we can say, okay, the moving average didn't agree and the candle was very big. So instead of entering with a 1% risk, maybe I will just enter with 0.5% risk. Okay, so it doesn't mean that if the filters don't agree, you are not going to enter at all. Some people prefer saying, I only want to take the super high probability. I want all of this to be in agreement with my setup before I will enter. Other people say, okay, I'm still going to enter, but I will just use less risk. Okay, then you place your stop loss and you take profit, and from there you monitor the trade, okay, to exit at the second close on the opposite side of the Bollinger middle band. Okay, now basically to summarize, guys, you've got a few choices. You can complicate trading, okay, or you can keep it simple. All right, you can follow the indicators, or you can follow the price. Then you can either be a disciplined and a focused trader, okay, or you can be unfocused and undisciplined. But at the end of the day, the choice remains yours. So ladies and gentlemen, from my side, thank you very much for attending the webinar. Okay, it was lovely to have all of you here. We will now have a few minutes. I see we already reached our hour. We will now have a few minutes for questions. So those of you who've got questions, you are more than welcome to ask them now, and to the best of my ability, I will try to answer them. I hope you guys enjoyed it. Samuel, which time frame is this applicable for? Okay, Samuel, let's quickly look at MetaTrader 4. From my side, I would say any time frame. It's applicable for any time frame. Okay, it's a technical analysis principle. The Bollinger Band squeeze, the breakouts, the trend following. It's all based. The strategy is based on sound technical analysis principles and sound financial principles. So any time frame can work. However, on the lower time frame, there's a lot more noise. So be prepared to be stopped out a lot more. Okay. So let me give you an example, Samuel. Let me give you an example. I'm going to just delete these lines. Okay. So currently I'm on the hourly time frame. Okay. And let's go to, okay, let me zoom out a little bit. Okay. You can see here's a nice Bollinger Band squeeze. There's a buy trade. Bollinger Band squeeze over there and a buy trade. Okay. There's a Bollinger Band squeeze, but price went down and the moving average stopped us from taking a sell there. Okay. And here's ranging. So probably we would have only gotten our 1-to-1 risk reward trades over here. Okay. There's a Bollinger Band squeeze. There's a buy setup and we were going to exit the trade right over there. Okay. So this is the hourly. Let's look at the 5 minutes, whether it looks the same. There will be a lot more noise, but okay. So there's the 200 period moving average. Here's our buy. There's a buy setup. Here's another. Can you see the Bollinger Band squeeze here, Samuel? Okay. So you see the Bollinger Band squeeze there, the inside out, and a nice buy setup over here. Okay. There's some short setups or sells, but this 200 period moving average stops us from doing that. And okay, it's also asking what other currency pairs, instruments. Okay, that's a very good question. Let's see. This is Euro USD. Guys, everyone is talking Bitcoin and Ethereum, Litecoin. Let's see if it will work on Bitcoin. Let's take a Bitcoin chart. Let's see. Okay, guys, do you see the Bollinger Band squeeze here? Okay, we're not going to take the buy signal because 200 period moving average is stopping us. We've got inside. Let me zoom in a bit so you guys can see clearly. Okay, we've got inside out. So this is a perfect sell. And look all the way, we're going to ride this trend down. And it's just after a Bollinger Band squeeze over there. So I would say this was an excellent setup. Okay, what else? Any other currency pair? Okay, so you can go and test this on any time frame, any currency pair. But Samuel, I would suggest the hourly, 4 hourly, or daily. That would be my suggestion. I hope I answered you on that one, Samuel. Then Dixon, is there always a downward move? A downward movement after a squeeze? Okay. Now, Dixon, usually after the squeeze, there'll be a false break and then it will continue with the trend. That is a lot of times what happens. Sometimes it just doesn't happen like that. But no, you cannot say that there will always be a downward squeeze. Let me look at a few examples. Let's try to find a upward move. I'm going to take another currency pair. Let's try USD JPY. Okay, so Dixon, can you see here? There's a Bollinger Band squeeze there. Can you see the bands are very wide over there, very far apart, but over here they are quite close to each other. And look at this nice upward movement after that Bollinger squeeze. Okay, so it depends. You cannot say there will be. Let me look at another example for you here. Can you see here the bands are so far wide? If you look there and there, can you see the red lines? They're very far apart. over here, they're quite close. And immediately after that, Dixon, can you see this very strong up move, a quite rapid and a strong uptrend? Do you see that, Dixon? Excellent. Okay. I hope I answered you there, Dixon. Then, okay. Christian, you're asking the second exit, okay? The second exit, okay, let's quickly look at your second exit again. All right, so basically, when you buy, you're gonna look for the second candle that closes below the Bollinger middle band, okay? So Christina, let's quickly look at an example here. I'm just moving this question box. Right, let's see. Let's just look at an example here. Okay, I'm just going to take the first example. Let's use this one. Okay, so we've got, no, that's not a good one. That candle is too big, it's the wrong side. Okay, let's say we entered over here, this big candle here, even though it's very big. So we've got a candle close inside the two blue bands, another one inside the two blue bands, and then a close outside the blue bands. So we sold here, okay? Now, to exit this position, we are looking for two closes above the Bollinger middle band, okay? Two closes on the opposite side, okay? So Christian, this is the first close on the opposite side. I'm going to zoom a little bit in. So we sold over there. This is the first close above the Bollinger middle band. Do you agree with me? But the second close is not above. The second close is below. So we're still in the trade. We're still in the trade. Now we have another close above, but the second close again is below. So we're still in the trade. Now there's another close. No. Okay. That's the, we go down. Now we've got another close above, first close above, and the second close is also above. So we will only exit that position right over there. Does it make sense, Christian? The second close on the opposite side of the Bollinger middle band. Okay, I hope that answers you. Then Homotso. Okay, thank you very much for that. Homotso is saying you've been using this strategy since the seminar and your winning trade percentage is above 75. Homotso, I'm very glad if that if you're having success with this strategy. That is something very nice for me to hear. There was a lot of work that went into developing the strategy, so that is really nice for me to hear if you can also be successful with that. Okay, then Kunle Daniel, what do you mean by inside, inside out? Okay, so Kunle, I'm quickly going to go back to the slideshow then with inside, inside out. This is just something I used to say to make it easier for me to remember and make sure that I am actually having a valid entry. Okay, so let's look at this. Yes, right over here. Okay, so Kunle, we said our first condition. Okay, wait, let's go a little bit back. Just find the right slide here. Okay, here we go. So we said our first condition for this setup is that two candles must close in between the upper and the lower one standard deviation bands. So that's the blue bands. Okay, so two candles must close inside of these two blue bands, and the next candle, okay, must close either above or below. So inside, and this one closed outside of the blue line, outside. So that's where the Kunle, that's where it comes from. Inside, out. Okay. So that is just something to help me remember and to help people remember and to make sure that there's no doubt as to a valid entry. So I hope that answers your question as well. Okay, if there's no more questions, I can see it doesn't look like there's any more questions. Ladies and gentlemen, thank you very much for joining me with today's webinar. It was lovely to have you all here, and I really hope that you've learned something. And yes, may you be very successful in your trading. And please watch your emails. We'll be having another or a few more webinars soon. So thank you, everyone, and goodbye.